Okay, good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, June 12th. Michael Boutros here with you this morning, guys. We just got the release of CPI numbers. Came in at 2.8%, so a little bit stronger than expected on the headline read. We're looking for 2.7, but core year on year, which strips out food and energy, came in at 2.2%, right in line with expectations. So a lot of people were looking to this to see, what implications it will have for tomorrow's FOMC interest rate decision. We are expecting the Fed to raise interest rates by 25 basis points. I don't see anything here in today's data per se that would upset that. Month-on-month core came in at 0.2% as expected, core 2.2. Yeah, so looks like inflation figures, although the headline figure is slightly stronger than expected, broadly, we are pretty much in line with expectations as far as inflation is concerned. Remember, the Fed's preferred gauge is still the PCE, the personal consumption expenditure, but certainly the CPI print here in line with expectations. So good to be with you guys this morning. Lots going on. Wow. So we had a historic summit last night with Trump and Kim Jong-un from North Korea. It doesn't really seem concretely that anything got done, but certainly things seem to have went well. Asia markets were up in overnight trade. U.S. markets still a little shaky ahead of the open here. But on to the next event risk. That was kind of the X variable that I told you about. Really unforeseen. It's a variable like that. It's very hard to trade through. So markets have been sort of in a holding pattern. We have seen some nice gyrations, but we're not really going anywhere on any of these crosses yet. So all bets are off. We're still kind of holding on for the interest rate decision. Like I said, we're expecting the 25 basis point hike. The interest, the focus, if you will all be on the updated projections as they pertain to growth, inflation, and employment. It's hard to see them coming out dovish tomorrow, guys. Just with the employment numbers where they are, with inflation starting to pick up, this trade war thing is going to continue to loom over. We'll see if we get any commentary from the Fed tomorrow on that. Remember, we don't only get the quarterly projections and updated assessments, but we also do get that presser, okay, with Jerome Powell. So this will be his second presser as chair, and certainly that Q&A section is always interesting to see what kind of information is leaked out. So keep the powder dry. Looks like it's still going to be a very interesting 24 hours right after the FOMC. Obviously, we still also do have the ECB on tap next day. So for the euro, we'll go over the implications for that. Everyone's focused on what we will see with regards to commentary from Mario Draghi on a normalization, right? When they're going to start to really scale back on some of those QE operations. On the menu for today, obviously, we'll hit the DXY real quick. There's really not much to update there. Swissy is still holding that same pitchfork that we were looking at 2.5 weeks ago, pressing resistance there. Sterling, you got a nice little pop. You did get some sterling data in overnight trade. Employment figures came in broadly in line with expectations. Average weekly earnings, 2.8%, slightly missing 2.9%. So again, that wage inflation, same thing that's happening in the U.S. You're trying to stoke, not really starting to gather pace. So pound did see a nice rebound off that support level we were looking at, but we're coming right back. So pound dollar, Aussie yen, and gold. Gold is still in the contractionary range. I thought maybe if something were to materialize last night with the nuclear summit, maybe you get some play there. Markets might be still on hold for the interest rate decisions coming up over the next 48 hours. So gold is still, that could go either way, but certainly I do think this week you get some play on that. We'll circle back and hit euro, Aussie, and dollar yen. Any other trade setups you'd like to review? Or anything I didn't mention, feel free to throw it on the message board, and let's jump right in. Hey, Ty says euro has an inverse head and shoulders and a symmetrical triangle on a 4-hour chart. So I do still like the euro long. If you're on the swing trades, Ty, we're still long on the euro there. Our stop's at 17.20 at this point. So we lock in some profit on that long that we took from 16.70 earlier. But I do like the euro to the upside. It's just stalling out a little bit, but let's take a look. So first things first, real quick, here's the DXY. I mean, we looked at it earlier in the week on the Sunday update. Nice descending channel formation, right? Left the possibility for a rally towards 93 before we start to call this bullish at all. And we've kind of done a little bit of nothing. You know, we came right into 93.90, right, same exact level, and then we pulled right off. Okay, so we came right into it. We pulled right off. This thing has simply set a very clean and tidy weekly opening range. Um, you know, no change. All things held constant. The ideal scenario is that we hold last night's high. We hold this high and we break through the weekly open and look for that drop towards 90. The first target is 92, 96. That's 100%, two equal legs off the high. The big play is down here. And it's funny that you should mention, Ty, the inverse head and shoulders that you're looking at with the euro, because you can also, you know, make the argument here on the DXY. Okay, looks like you could have left, right, or left, head, right, shoulder break. The measured move, and we brought this up yesterday in the webinar, the measured move of that, the conservative measured move of that neckline break would actually call for a drop into 92.40 is down here. First things first, though, right? We don't want to get ahead of ourselves. You know, the focus is for that scenario to play out, Ty, we do need to see that high hold. So at, you know, no change to any of the levels from earlier in the week, guys. Our bearish invalidation level was 93.91. We turned just ahead of that. You know, now look for a break of this weekly opening range. Ideal scenario, we break lower. At the end of the day, the FOMC is on tap. Okay, so Ty, we always have to keep in mind that economic calendar and the fundamentals, which could just, you know, spur real strong price action. So as we head into those interest rate decisions, just keep that in mind. 93.90 is still sort of my line in the sand. If we get through that, I'm neutral, not necessarily bullish. Don't want to jump on the long side. But that would sort of invalidate the level move to the downside that we've been looking for. So keep that in mind on the DXY. Again, just on the broader view, here's what we look like. On the daily chart, this is your monthly open here for June. All we've simply done is kind of almost pull right into the monthly open and pull back, but this is still your key range. 94.27 is still the level I would need to see compromised on the upside to get bullish again. Okay, while below here, the risk is for that move lower in the index. Will the dollar sell off on FOMC? It's tough, you know, it's tough to kind of pre-play that or pre-position for that. You know, they're likely to be a little bit more optimistic, and I think the markets are sort of taking that in stride. And keep in mind, guys, that, you know, this interest rate hike tomorrow is largely priced in. Anyone who thinks that the market's definitely or the dollar is going to rally tomorrow because of the interest rate hike, keep in mind all you got to do is go back and look at the chart. We've been ripping. Okay, just from the low that we made in April, you know, the index is still up more than 5%. Okay, this is the market pricing in that expectation. So it's really about the commentary and it's really about the dot plot. If we do get that expectation for that final hike or a fourth hike, let's call it, then there's room for the dollar to get through this. All things held constant, you know, the technicals are the technicals. Keep in mind the weekly chart for the DXY looks like this. Okay. Nice reversal that we made off of resistance and the pullback. Could see a little bit more, you know, capitulation here. But below 94.20, that's the risk. Any questions on the DXY? Obviously, we have a webinar tomorrow morning, so we'll go over the implications right before the release one more time and see exactly where the dollar crosses are positioned. Excuse me, and you know, hopefully we get some play on that. Hey, Ty says whispers about the Fed ending QT, thinking QE, and pointedly saying they will not invert the yield curve. Yeah, Ty, there's all kinds of speculations and whisper tightening. Yes, I see what you're saying. There's all kinds of speculation. Yeah, I read those reports too. Bloomberg has a couple of different articles right now on what they're expecting. So does Reuters. I try not to let that filter into my trading. You know what I mean? Ty, I'm looking at what the technical picture looks like. I want to be around when the release is out, and I'm going to play with what the market gives us. At the end of the day, there's no way of knowing exactly what they're going to say, but we do know that the markets are well prepped for this hike. Not only that, we're well prepped for the third hike, right? That's what the markets are pricing in. It's whether we get that fourth hike or not. Inversion of the yield curve, obviously that's not something the Fed's, you know, ever been like cool with, but It is what it is. We'll have to see what the commentary looks like. From a technical standpoint, below 94.20, the risk is for the dollar to still pull back a little here. Okay, so what does that mean for the euro? Let's just take a segue right into the euro since we're talking about it. Remember, DXY coming off resistance, euro, no surprise, coming off support. Okay, we talked yesterday and last week about the fact that the euro did make a new low past the November lows of last year, where the DXY did not. Again, something very indicative of turns, and certainly here's the rebound. So the major first hurdle of resistance, just objectively, takes you into 1916. 1916 is the 2018 opening range low. That's basically your January low. Okay, and it's also your 52-week moving average. So a nice level of resistance. Just higher from that, you have the yearly open. You have those former swing lows from last year, or excuse me, from 2012. What am I talking about? This is the weekly chart, and the former swing lows from February. So all the levels are pretty stacked up. You know where to look on the upside if we rebound. The whole focus right now is, does this have any legs to get up to our next target? So the weekly chart's pretty clear as far as the levels are concerned. Euro on the daily looks like this. Okay, here's that same formation. There's the dip past that November low. Here's the rip and the first level of resistance, 118.27's level we've been talking about. It's also the former swing low that we made back here in May for the May opening range, and the 1618 extension from the decline off the highs. So a nice level. That's been the opening range highs essentially for the month. Here's euro just below resistance, right? Intraday, and Ty, this is where I think you like this stuff. Yes, I see 100% the inverse head and shoulders that you're looking at could be a decent play. Again, the measured move of that play would take you into 119.46. Okay, neckline to the head. So that'd be the measured move. These are all precursors, right? We map these levels out so we know what to do in the event of the breakout to the upside, but we still have to clear resistance at 1827. Okay, so our stops obviously on the swing trades, again, guys, 117.20. If you're trading with a position that we've had on the swing trade, don't let this alter that outlook. We got to stick to our game plan as far as the swing trades are concerned, to maintain our risk reward ratio. For new intraday positioning, if you're not holding anything, the weekly opening range is set. I obviously don't like that we slipped below that, channel. It was a 3-point touch, so it looked pretty legit on the break there. But here we are back above, which is good to see. Look for that break above 1827, levels unchanged. 119.10 would be a soft target, but then again, 119.46, 119.61, big region. You have a 1618 extension from the advance off the lows. You got that measured move for the head and shoulders inverse break, and you have channel resistance all lined up right here. Okay, obviously, guys, don't look for any major key big plays ahead of the Fed and ahead of the ECB. This one's going to get hit from both sides over the next 24 hours, right? So for the euro specifically, the event risk and the volatility spike expectation is certainly there over the next 48 hours. Do you have any entry prices? An invalidation level 116.27. So for me, 116.36. I think I noted 116.16 in the report, Ty, as my bullish invalidation level. Essentially, if we break below this region here, okay, you have the former swing highs from 2016, okay, and then this would also necessitate not only a break of the weekly opening range, but a basic slope too. So if we break below this range, I do think you're just looking at straight on resumption for a much larger move lower. That's not my favorite scenario, but that's the scenario if it does break that support level. So that's my my bullish invalidation tie. Near-term resistance 1827. That's what needs to break to the upside to fuel the next leg. If you do clear that, you have a lot of room. I have over 70 pips maybe to the upside to 1910, 1909. So levels are unchanged. Here's what it looks like on the 120. It looks like you just have a little bit of a consolidation just below resistance. So series of higher lows, series of lower highs. Look for that break. Ideally, we see a move to the upside. But it's all going to have to see if the market wants to wait on the FOMC and the following ECB interest rate decision. If they start to reduce QE and if the ECB starts to talk about normalization, look for the euro to take a little bit more of a breath, I think. So could get some really nice volatility here over the next couple of days. Don't really like the near-term formation given out here, but we'll have to reassess this one. Any questions on euro? It's number 1 and 2. Okay, so along lines the euro and DXY. Obviously, last night we looked at dollar Swiss, which is one I haven't updated in a while, but we've been following in the webinars. This is the same fork, guys, that we've been following since the 29th of last month. It's the same exact level. Okay, we came right off the lower parallel late last week. You got a couple of different parallels there, not only the lower pitchfork, but also a parallel of just basic resistance, drop down, a really nice area where we turned. So we opened the week, or last week, we came right into resistance, and we opened this week just below the upper parallel here. So the question is, dollar Swiss, does it want to stay into this formation, or does it want to see a topside correction before moving lower? So for me, the game plan has been to fade moves into 98.90 if you get a decent stretch. This was an opportunity. I didn't take it. Obviously, it's in the middle of the night here. Or 99.22. This would also be another level if we hit. It might be a breakout kind of washout play before we move lower. That could have been it. I don't know. But it's still in the formation. And if we take a parallel of this same slope, and extend it off that high, that still gives us resistance into 98.90, right, into the US Open, right? So I don't know if I've missed this one or if I'm still looking for entry. If we get another sort of advance that fizzles out, you might not even get that high, but it might be an opportunity. On this one, it's still in the trade. Remember where we're coming from on this trade, okay, as far as the long-term picture is concerned. Here's the daily chart. Well, let me take you to the weekly chart first. Here's Swissy. Okay, we came off a huge area of resistance. This was last year's October, November highs, the 786 retracement. If you bring the 764 retracement, it's even closer, and basic slope resistance. So we came right into it, pulled back, former slope resistance, now support. This was the play. The play that we've been talking about for the last couple of weeks has been this reversal into former slope resistance, turn support. What do we do from here? Well, the implications for the dollar are still pretty bearish. But on this pullback, this is completing now 4 weeks already of down. This would be a 5th down week in a row if we got it. I like to look a lot sometimes just to go back and see how many times we've seen that many declines in a row. And we've seen that a couple of times. Here's the last time we had 4 weeks down. We got a single week recovery before making a new low. Prior to that was here, 4 weeks down. We got a single recovery before heading lower. And the last time previous to that was right here. Well, it's because there's a gap there, but that was 4 weeks down, single week recovery before we move down. Now, this kind of analysis doesn't suggest that it's always going to be the way this plans out, but this is what we do when we're trying to assess probability. The last 4 times that we've seen 4-week declines, there's been a single week rally before making a new low. That would suggest, again, that this week you kind of want to play a little cautious, right? And with the Fed on tap, that might be the surge that we need, one last washout, little rebound here before we break if we are going to indeed head lower. So for dollar Swiss on the daily, it looks like this, right? Could be a bull flag, right? But a lot of times the turns will start out as bull flags. Long story short, 99.22, there's that level where this thing could still pop up and still keep us broadly within the confines of this descending formation. So tomorrow on the Fed, if we get a dollar surge, this is the one I'll be looking at to see if we can get a decent fade. 99.22, 99.54 max, areas of interest for possible exhaustion. On a downside break of the objective monthly low, you're looking for this beautiful region here, 97.25 into the yearly open. Both of those converge on the lower parallel over the next few days. Intraday looks like this. Okay, same slope, no change. Questions on Swissy? That is number 3. Okay. Pound. Like I said, we did get some decent data out of the UK claimant count. Came in at 2.5%. I think we got 146,000, which is a little bit higher than the expectation for 410. Here's what sterling looks like. So, you know, I like it higher. I don't want to chase it. I have a small position on. It's not a very good entry, but here's what it looks like on the weekly charts. So my concern since the start of the week, and we talked about this briefly yesterday, was right here, right? You have the 52-week moving average. You have the high week reversal close for 2017, comes in at 134.95. Remember, that's the line in the sand that we've drawn for a while now that we need to see a breach above to get us that stretch to 36.70 and above. Just coming off of the lower slope, right? Rebound off of slope support. Here's the 50 line offering resistance, and it converges on that 52-week moving average. So you kind of know where we are in the broader scale of things. This break was big, but we're just bouncing off support. So do we stretch higher into the median line before we kick back again? Or is this it? Near-term picture looks like this. Here's sterling on the daily charts. Again, beautiful area of where we turned. August high close, okay, 50% retracement of the entire advance from the 2017 lows, lower parallel, okay. Now you might have seen Jamie posted a chart on this on the swing trade setup report last night as well. He's looking at the same exact slope. We've been following this for a while now. Here's a parallel that he pointed out from this low, perfect touch, break, saw as resistance, break, now converges on the monthly open. So it's 32.90, okay, is the monthly open. So I kind of want to see these things like kind of dip towards 33, ideally, for the hold. There was an opportunity, you know, obviously here, okay, on this drop late last night. Really nice rally up here. Didn't quite make it into the upper parallel, but here's the failure. We got that data this morning that wasn't all that good. And here's the failure. Nothing changes on this, right? Yesterday's idea in the report was to look for entries for the long side, both into 33, 38, 33.45, and 33, right? For possible exhaustion for long entries. So we got the drop into 133.38. The low was 33.40. Okay, right into that sweet spot. Here's the rally. Now, you can talk to some people and they swear by all that is good that this is a bear flag, right? And certainly it is a downtrend upslope channel. Yeah, that is the definition of a bear flag. But I can also look at this and make the argument that this is a bull flag, uptrend, down slope within an uptrend, and then we should be looking higher. Any way you look at it, guys, you know, the best thing to do is stay as objective as possible. The whole game plan was that we were rebounding off of key support, both on the daily chart, both on the weekly chart. Really nice. We were looking higher. We talked about 34.50 on the way up for a couple of days. That, you know, false break came right back below. And we started the week saying, look for a drop into one of these two levels to try to get long. This might have been the long, okay? If we break this low, the game plan stays unchanged, okay? That might be the Fed, that might be the ECB. I don't know what is going to spur or offer the catalyst, but if we do break lower, same plan. Look for a drop into here, 33, and again, we want to see a hold there if, in fact, we are going to make another high in pound, which is kind of what I'm hoping for. So, you know, let's see if the Fed can give us, you know, that exhaustion blow off in the dollar. Again, like sort of ideal scenarios. You come into, we'll look at this obviously again tomorrow, guys, but sort of ideal scenarios. You come into the Fed here, you're kind of still holding the opening range for the week. You spike one more high, and then kind of the market starts to fade it. That would be my ideal play, right? That would be a euro, a jackknife move, maybe lower again before it starts to rally again. Same thing with the pound. So things are shaping up pretty nicely for the Fed. We want to see some volatility there. But broadly speaking, the levels remain unchanged. Any questions on the sterling? $33 is my line in the sand. I want to see the market hold above the monthly open. Okay, if this is heading higher. The break-even stop, it's going to get hit. If it gets hit, it gets hit. But still going to be looking for that exhaustion on the low for pound. That's number 4. Okay. Let's hit the rest of the dollar crosses before we go into some of the yen crosses, because I do want to look at Aussie yen, which is a trade. Pooja, are you in the room? Yeah, you are. So Pooja, you brought me into that Aussie yen trade yesterday. I've been all about it since. I've been like stuck on it. Do you think the DXY has turned higher, or we are still in a downtrend? So Ty, what time frame are you talking about? DXY obviously turned higher. We were crazy bullish after this break, right? Then this was the big resistance. We flew through it. It became rock solid support. And here's the exhaustion just above the upper parallel. So if you're asking me, okay, daily and weekly. Okay, so for the daily, well, first of all, for the weekly, we should start on time scale basis, right? For the weekly, we're still in the downtrend, Ty. Doesn't mean I'm necessarily blind bearish to the dollar, but even this whole rally, okay, this consolidation off of lower slope support, this whole rally took through resistance, is testing downtrend resistance. So broadly speaking, the focus is still against this region. It depends how far back you want to go, Ty, because if you look, back to the 2011 lows, then no, we're still broadly in this longer term uptrend. And with the markets really expecting and the Fed expected to normalize and begin to move higher on interest rates, broadly speaking, yeah, the dollar is probably still going to be heading higher. The focus right now is against this resistance region. So if you're a long-term trader, you're looking for a bigger pullback to get long again. If you're a near-term trader like me, I'm looking to play the downside off resistance. So if you're asking me, do I think this correction's over? Again, below the monthly open, below that 94.20 level, I still do think you look for one last low in the DXY before we turn higher. Ty, does that answer your question? Does that make sense? My invalidation is 94.20. So a break above that would put me right in line with expectations for a move higher. He says, yes, excellent. All right, cool. Good stuff. So that is sterling. Aussie. Here's what's going on with Aussie. So this was our best trade for the last couple of last few weeks. Here's what Aussie looks like on the Aussie, on the weekly charts, and this is kind of the big determining factor this week. So weekly chart for Aussie dollar. Reversal off support, resistance was right here. We came right shy of the measured move. Remember, we had an inverse head and shoulders break here that was validated. That gave us a measured objective target at 77.09. The high that we made yesterday was 76.77. So didn't quite make it there. And here we are pulling back a bit. The major key levels from the weekly standpoint are unchanged. 74.80 major support on weekly close basis. On the upside, you still have to contend with 76.36 because it's there, and we still haven't gotten a weekly close above it. But this is kind of your key region. You have the long 200-week moving average at 76.80. And then 77, you have that measured objective target for the head and shoulders formation break, right? That formation break gives us an objective measure target at 77.09. So here's the daily chart. Again, messy on the break of resistance, but it's only a 2-point resistance, so you don't really want to stress this slope. I kind of haven't really been paying much attention to it. The lateral levels seem pretty clean, though. Note that where we capped out last week on the 6th, that high was the exact trendline resistance dating back to the 2016 lows. 1 touch, 2 touch, 3 touch, break acceleration, perfect resistance. So you're starting to think now, okay, maybe you're not going to see that 77.09 level and the magnitude of the reversion kind of has me thinking I still want to fade weakness or fade strength now. I don't necessarily think I want to get too aggressive on trying to kick that last target into 77. What does the near-term picture say? Oh, and one other thing, momentum on the daily chart. Look at that. Perfect hold at 60. And what do we always say that people um, tend to overlook these subtleties in momentum signature. In strong uptrends, you see support, you look to see support at 40. In strong downtrends, you look to see resistance at a 60. And certainly since the start of the year, once we broke back below 60, momentum has been unable to mount any offensive above 60. So if that high holds and momentum holds 60, inherently you start to think, the risk is to the downside here. So look, the monthly opening range was set within the first couple of days of the month. The monthly opening range is set just below former slope support, a 3-point confirmed support, now resistance. And the critical levels on the weekly and daily charts. Intraday, it has actually still been clean, okay? This is the same slope, guys, that we've been working with on Aussie for the last couple of weeks. Here's Aussie earlier in the week, right? So here's Aussie on the open before the Sunday open, okay? What is the bottom oscillator? Ty, I use just a basic RSI, relative strength index. I don't complicate things. I don't, work too rigidly with it. He says, okay, yeah, Ty, I don't work too rigidly with it. It's just there as an added confirmation tool to help me ascertain bias, to help me ascertain extremes. I'm not rigid on any oscillator. Okay, we study price action here. Oscillators are all backwards looking, so I'm very hesitant to put too much emphasis on it. That said, we turned right ahead of the lower parallel, right? And we were starting off the week saying, look, if we get a drop towards support, let's try to see if we can get the rally into one of these 2 targets. But these 2 targets are actually where we would start to look for exhaustion for a turn lower. So you didn't really get the drop to open up the week. You started just pushing into those targets right off the bat. So here's 76.18, decent pullback, didn't quite get to the median line. Here we are again. The 618 of that decline takes into 76.33. Both of these are levels of interest for possible exhaustion. You know what I mean? If we get through this, right on. I'm right back favoring, buying pullbacks, looking for 76.89 and looking for that inevitable target at 77, the head and shoulders inverse target. If the rally fails here, as kind of what I'm starting to suspect, then you'd look for a break of this support and a drop into this zone here, 75, 20s, even 75 handle for support. So I'm just because of the way that this thing turned, really strong divergence. You love to see these strong divergence signals, price action making a new high, the oscillator making a lower high. This was the spill down, right? The question is, do you still have to make one more low to satisfy this correction before moving again? So I'm kind of on the fence here. If we get one last spike to 76.30, I don't have anything on this, by the way. If we get one last spike in 76.30, that might be a decent entry. But that's also my bearish invalidation. So if we get through that, that would invalidate the pullback idea and you'd be looking higher. So Aussie, and the reason, again, guys, keep things as objective as possible. Aussie came from a spike deep into oversold territory. That was the deepest spike that you got pretty much since April, okay? You see last time we were down here in momentum, the market still had plenty of downside to go, right? Overbought keeps us bullish, overbought keeps us bullish. Even this overbought keeps you still bullish. Then the divergence signals when things start to turn. Momentum, if it fails ahead of 60, right? So it gives us a little bit more room to the upside. Market can get maybe into 76.30s, might be the area of which, again, you start to look for exhaustion. So I'm going to be looking to see, and again, we have the FOMC on tap. Obviously, the dollar is going to move on this. So that's sort of the game plan. We'll reassess this tomorrow morning ahead of the release, but thinking you get that last move lower here still in Aussie. Questions on Aussie dollar? I ate the stop on Aussie yen. It hasn't done much since Puja. Yeah, for the Aussie, I saw that move yesterday when it rallied. It popped through that resistance, but I was still trying to fade it. I still think we're on to something here because the weekly range highs are here. Let's look at Aussie now. Is there any questions here on Aussie dollar? Okay, going once, going twice. That's number 5. Number 6, let's do Aussie yen for Puja here. So every now and then you guys will throw out a pair that'll just mesmerize me and I'll get like glued to it. And this is what happened when Puja brought this up yesterday um, on the webinar. The 2017 Open comes in at 84.25. 84.71 is a 100% extension from the advance off the lows. So, that region has capped the advance both that we made in May and the advance that we made last week in Aussie yen. So, basic support, basic resistance. Excuse me, you got yourself a really well-defined range, period, right? Trying to look too deep into things. The top side break of this range, while you're looking for the 52-week moving average, former slope support, that's around 85.60s, 85.70s. Downside break looks for the 1618 extension, that takes you down to 79.45. So you have both of your levels mapped out, very tidy range. Until the range breaks, we're in it. So yesterday we were kind of looking at this, and I even published this weekly chart on Daily FX just to kind of highlight this range. Last night I showed you the intraday charts, and here's what it looks like first on the daily, okay? And then on the intraday, here's the daily. So that basic trend line support, okay? Boom, boom, boom. I have that in dark red. Slope support for the near-term advance, just off these two lows. If you take a parallel, caught these two lows pretty nicely. If you take a parallel, caught these 3 highs pretty nicely. Okay, this is just a parallel extending off that 1 point to see if we do get the topside extension, you know where to look. But broadly speaking, this reversion that you got here, again, on divergence, right? Remember, we always like to highlight when the divergent signals, the closer those two reference points are to 50, the stronger the signal. So this was a really decent point in my humble opinion. Again, bring it into a line chart to really show it more obvious. Higher high in price, lower high in the oscillator. So right off the bat, coming off resistance, this should turn us, inherently bearish. So again, the question is this the extent of the pullback? Well, I kind of think that this thing still needs to make another fizzle out and a new low. This looks like it could be a 1, 2, 3, 4, 5 to the upside. If it is a correction, simple ABC still looks for one more low to the downside. So I'm still thinking of in the mindset of fading strength. Okay, now that's all predicated on a hold below this region. Okay, just putting that on the table there. So the daily chart's pretty clear as well. Intraday looks like this. So yesterday when we were talking the webinar, we were butting right up against the 618 retracement. Puja, it was a decent area of which to start to look for a turn lower. I hear you, but there was just nothing in momentum, right? You even got that quick 60 pop to the upside, got through 786 retracement, held as resistance, and we pulled back. So on this one, ideally a stop against this right now would keep you looking lower. This is a very, pairs that tend to be considered, whether you want to argue that now these days or not, but risk sensitive pairs because of obviously the dynamic of the carry trade with the interest rate differential here. But risk has been sort of muted, if not mixed. I thought this would be a good one because if things kind of didn't materialize yesterday with the nuclear summit, I thought you might finally start to see this pullback materialize a little bit more. But markets didn't really necessarily rally. Asian markets liked it, but U.S. markets are kind of, they're kind of blah about it. So I think there's still a lot of people on the sidelines waiting for FOMC, guys. Here's the SPX just to give you a quick look at the daily chart, right? We were talking about this level last week. There's the break, man. So we're finally shifting higher here today on the session. We were a little bit lower earlier, finally shifting higher just ahead of the open in the U.S. markets in about 15 minutes. But watch these levels just higher. I would actually shift this to the 786. That actually matches that high and gives you a confluence rather with that slope. So for Aussie yen, it could still get a kick higher a little bit within this range. Ideally, though, I am looking for a high to fade puja. Yeah, it hasn't really done much of anything, but I'm still liking the lateral levels. Remember, the weekly open comes in here. I highlighted this yesterday. And this is really the break that you would need, in my opinion, to just kind of like validate the reversal, at least for the near term, on move lower in Aussie yen. So here's price action making a higher high, oscillator making a lower high. I'd like to see this high hold for a move lower. Hmm. Okay. I'll come back to this one, but I do want to see this high hold for a pullback. Okay, that is Aussie yen. Last but not least from yesterday, Pooja says, okay, thanks. Yeah, Pooja, let me know if you have any other questions on this one. I've been tracking it, like I've been glued to it, and it's kind of not been moving, so it's been uh, an effort in futility. But I do think we'll finally start to get a move. Markets, like I said, if things weren't going to move on yesterday's summit, it's because everyone's waiting on Fed. It's because everyone's waiting on Fed. So moving right along, here's gold. Another one that I was looking at for this morning and for the Fed. Remember, gold has two major functions that we've seen historically. In times of concern over rapid inflation, you see gold start to rally. It's not what's happening right now. And in times of concerns over market volatility, again, you see that bid for safe haven support gold, and you're not seeing that either. That being said, the market is in a clear and well-defined consolidation pattern with a series of higher lows, series of lower highs. And heading into the Fed, this is again one of those trades where you'll get the clear breakout in one direction and the other. Downside break below 1291 still targets 1285. That's the big level that we turned from last month. Okay, we were looking for that rebound into resistance. We got it. Ever since then, we've just kind of been consolidating below this key resistance threshold. So a topside break above 1305. Okay, it's the 1618 extension off the low, but it's also former swing highs just above it. You have the 200-day moving average. Break above this region is really what's needed to validate the reversal, okay, for gold. And in such a scenario, 1314, 1315 is a big area of resistance, and that's your first major resistance hurdle on a breakout. So look, until we break this consolidation range, guys, if you're a real near-term trader and you want to intraday trade this, don't target anything outside this consolidation. Okay, once we clear it, the market's likely to give you a run. Odds are it's going to be on the Fed, especially if they hike. I mean, if they give us a hawkish tone to suggest a fourth hike, if that's the case, it's probably going to see gold lower, guys. Think about it logically. If the dollar is going to give you a higher yield, gold is a non-yielding asset. If there's not concerns about market sell-offs, typically when you see yields move higher for US dollars, those tend to put a little bit of a downward pressure on gold. Okay, all things held constant, if the dot plot stays the same, expectations for 3 hikes this year are held, I do think the potential for that 1305 break gives us the topside move. So another one I highlighted yesterday, I just kind of wanted to prep the levels so you know what to look for heading into Fed for gold, just because it's such a clear consolidation. We're now testing lower bounds, but levels remain unchanged. Questions on gold? And again, the weekly charts are very, very clear on this one as well, right? We're looking for a breakout of this key range that we've been holding for more than 4 weeks now. Okay, that is number 7. Number 8, we skipped dollar yen. Okay, so dollar yen, something a very sensitive trade to any U.S. data. Generally speaking, dollar yen on the weekly looks like this. So we got stopped out of the short that we were on the swing side of trades. It was a break-even stop, so no harm, no foul there. But um, I still think that we were on the right track. Here's what gold dollar yen looks like on the weekly chart. So this is the level that we were trading against, guys. It was the 52-week moving average converging dead on with that 2012 trendline support. 1 touch, 2 touch, 3 touch, 4 touch. Count that if you want. Break, acceleration, resistance, false break, and reversal, outside reversal, mind you. Okay, outside weekly reversal off resistance. And on the way back, we were looking to fight that play. Here's the rally into it. Doesn't really look that convincing still. Momentum still holding 60 on the upside in weekly resistance. So watch that. Key resistance on the weekly chart still continues to highlight 1165. Jot it down, put it on a post-it note, whatever you want to do. That's sort of the big level for dollar yen resistance, right? And that's basically what we were trading against on the pullback from here. That's the weekly chart. Daily chart looks like this. Okay. So early in the week on the update, my bearish invalidation level that I had mentioned to you guys was 1014. Okay. So once we broke 1014, as far as an intraday type of new positioning, it kind of invalidated our ability to kind of look for the short. Now we've since went and made a tag of slope resistance again. Here's what it is. Here's what it looked like on the open of the week. I was looking for that final drop here. I want to stay bearish below 1095. There's 1014, our bearish inval. We rallied to here. I was looking for triggers, didn't get any. We pushed higher into here. It stopped us out of the swing side of trades, but we stopped that gradient. Okay, here's what it looks like on the intraday chart. There's that same slope. Resistance, 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 break, acceleration, support, 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 break, move lower, resistance, resistance? Is it possible we just got stopped out and then this thing's going to turn lower? Sometimes that's the case. I'm not willing to throw a bet on this one before the Fed though. So look, 1160, like I said, is still the line in the sand, even if this thing rips higher tomorrow. 110.87, look for a possible reaction, but that's sort of the last line in the sand. That's also, like I said, on the weekly charts highlighted here as well. So the levels are pretty well mapped out. I don't know how to play this from here, guys. I don't want to jump back into a short. I typically don't, find that's typically a revenge trading type of strategy when you jump into a position right after getting stopped out. But things held constant. You know what I mean? If we get any play here today, might be a play down towards 109.85. 40 pip move or so, but don't get too aggressive. Don't get too aggressive. Dollar yen is notorious for movement on dollar data and its sensitivity to shifts in monetary policy because of its relationship to yields. So know these levels. Again, ideal scenario, you get some sort of rally to fade, but if we break back below 109.85, I'd like to see this thing back into those June open levels that we were looking for. Questions on dollar yen? All right, guys, that's the last setup I had, and those are the things that I've been following and will be following, have been following ever since the nuclear summit and all this, and basically heading into the FOMC. Keep those dollar crosses in focus. Euro Aussie is another trade that we've been talking about and been following here in the webinars. Guys, I just wanted to kind of bring up, look where we found support yesterday on that pullback. So it looks like this pitchfork formation that we added last week. Remember, we were very cautious. It looks like it may actually be in play. So it puts the emphasis right now on a breach above the weekly opening range high, which comes in right at that confluence here of the median line and the 50 line for the downslope. So you're basically looking at like 55.30s. If you see a topside break there, 56, 56.50s are the top side objectives for a Euro Aussie trade, specifically if the Aussie pulls back. This might be a decent one. Bullish invalidation. I'm going to raise it just above the yearly open. At this point, this median line confluence again. The median line here has been very instrumental in price. It converges on the upslope right down here, just above yearly open, around 53.90s, basically just below 54 would be bullish invalidation. Ty says, did you cover Euro Yen? No, I didn't, but we certainly can. Not a big fan of Euro Yen, but here's what it looks like, Ty. Euro Yen, where art thou, Euro Yen? Here's Euro Yen. So look, the only thing that's clean is the near-term outlook picture here and the fact that we're coming off of slope support. Remember, we were talking about this last week, and we did a couple of updates on the intraday charts. The last target that we had was basically this downside, 128.938, and then this. Okay, so we haven't quite extended into 131. I still think you do get the extension to 31, but if you're not long already on this, Ty, I don't want to encourage any chasing. So I'm kind of kicking myself too because I'm not long either. But that long that we played last week played out well. The pullback on Friday was really mean reverting, right? It was a pretty stringent drop off, but still kept us within the confines of the slope. I think you get that last push higher to 31. Near-term support, look for 29.38. Here's the daily picture. Okay, this is why the reason I don't want to get any more long exposure on this. So the break below the lower median line parallel saw a perfect tag of a nice confluence support, 100% extension, lower median line parallel, same slope of the highs. And here's the test of former support, now resistance. So I can't get excited about any more long exposure from here on Euro Yen. Don't get me wrong, it could break right through, but knowing direction, Ty, I always tell everyone in the room, is just 50% of the game, man. It needs to be a setup, right? A proper risk to reward, a proper risk threshold on the trade. I just don't think you have it here on the long side. So, take it for what it's worth. Not something I'm currently trading, but anything that you would see below 129.30 might be the onset of a bigger pullback. Other than that, still waiting C31. Does that make sense? He says, this is excellent work, and I am a new subscriber. Do we use this info email address to reach you? Do you do consulting? So Ty, I have a ridiculously busy schedule, but I always, set precedents for SB clients. So definitely shoot an email to info is the best place to reach me. Our intern will shoot any emails that we get from clients to us directly. I might not get back to you right away. Ty, this is the best form for us to interact. So I would encourage you to jot down any questions that you have throughout the day as you're trading, so that as you get into the webinar, you can kind of just throw them at me and we can work them out much faster. Relay time on emails for me is not the best, but I will respond. I promise you that. Pete says the SPX. So I'll show you the SPX one more time. Here's what it looks like. Pete, it's still moving higher, but I don't want to get too excited because 2,800 is just higher, and that's a 786 retracement of the decline from the yearly high, but it's also slow, right? So if we take this formation we've been following off 2015, 2016 lows, it's been ridiculous. Parallels have been holding the lows, and I think that's the 50 line if I'm not mistaken. Yeah, it is. So the 50 line, okay. I could probably get rid of 38 too, actually. The 50 line for the formation, which is just the bisector of the lower quadrant, converges right on that 786 retracement at 28. So if we do get some more upside to go, I think near term, you got to be mindful also of the March high that we just made. So it's great. Look, this near-term formation that we added, this modified pitchfork, the median line was a perfect confluence again, and there's the break of the upper parallel and test of that parallel support. So we can ditch this now, but I do think near term you run that risk on 28. Pete, does that help? He says thanks. Hey, you're more than welcome, man. Okay, any other questions, comments, concerns? All right, guys. So we'll give you an update tomorrow. Again, we'll give you a nice little rounder right ahead of the Fed. one last look of what the dollar crosses are doing. Still have the ECB on tap. It's going to be an exciting week. Stay nimble, okay? And good luck trading. See you guys all tomorrow morning. Cheers.